are multiple different income sources to help fund your retirement once you eventually get there. Now, you might just have one source of income coming through the door, or you might have a mix or multiple different income streams to help support that retirement income that you need. Now, that's the most important consideration, is that retirement income figure that you need are all these different sources of income, whether it's a little bit from superannuation, whether you've got multiple investment properties or a few investment properties, whether you've got cash or managed funds, or maybe eligible for some Centrelink. All of those sources of income actually giving you what you need to fund your ideal lifestyle in retirement. In this video, I'm going to talk about the main source of income in retirement that we help clients with, but generally the main source of income that is going to support someone's retirement, especially in the earlier years, will be superannuation. Now, superannuation can be split across three different avenues or three different income streams. One, a standard account-based pension. Two, a transition to retirement strategy. And three, a defined benefit. Now, the first type of income stream from superannuation that can be used or commenced after you have reached the age of 60 and you have ceased a position of employment is an account-based pension. Now, an account-based pension can be used once you've hit your preservation age, which is 60 at the moment in Australia, and you have ceased a position of employment, or you have reached your retirement age, which is 65. You can use your accumulated superannuation benefits and move that across into an account-based pension. Now, there are some considerations with the account-based pension, and the main consideration is the limit on how much that can be transferred from an accumulation fund into an account-based pension. Now, the government has placed limits, and that limit at the moment is also known as the transfer balance cap, and it is on a per person basis. You can transfer up to $2 million of any funds from accumulation phase into an account-based pension. Now, the whole reason as to why the government has placed a limit on how much that can be transferred from accumulation into an account-based pension is due to its tax status. So while in accumulation phase, we've got some tax to consider. Tax is applied on any investment income or dividends or distributions at 15%. And if you switch any investment options, if you sell down assets, if you have a self-managed super fund, you have your property within that accumulation phase and you sell that property, any capital gain is taxed at 10%, assuming that you've held the property or you've held the asset for longer than 12 months. Once that bucket of money is moved from accumulation phase into an account-based pension, all of the tax is switched off. So any investment income, any dividends, any rental income, in fact, any capital gains tax, there is no tax at all once in account-based pension. So the government is limiting how much we can get into this account-based pension or this tax-free environment, because they are losing out on a bit of tax revenue in doing so. Now, the second option in terms of income streams from superannuation is what's known as a transition to retirement, or TTR. Now, what a transition to retirement is, or what a transition to or a TTR income stream is, basically once you've hit the age of 60, your preservation age, and you're still working in your current employment, there's been no cessation of employment, you're still working the exact same job, the exact same hours, you can actually use a portion of your superannuation benefits and commence what's called this transition to retirement strategy between the ages of 60 and 64. Once you've hit the age of 65, then anything within this transition to retirement, or TTR, income stream becomes unrestricted, non-preserved. Now, some considerations with this transition to retirement income stream opportunity is that there are some limitations on how much money you can withdraw from this transition to retirement strategy. So each financial year, there is a limit of how much you can take out, which is 10% of whatever the account balance is as at 30 June. Now, there are also some tax considerations to consider as well. Now, the transition to retirement strategy, or the TTR bucket of money, is still technically in accumulation for tax purposes. So what that means is Any investment income, any dividends, any rental income, any distributions or anything like that are still all taxed at superannuation's concessional rate of tax at 15%. And any investment options that might be switched, if you sell down an investment option, if you sell an investment property or anything like that, then there is still some capital gains tax to pay. However, any income that you withdraw from superannuation is all tax-free. It doesn't form part of your assessable income at all. The other consideration with the transition to retirement strategy is that between the ages of 60 and 64, comparative to an account-based pension where there is a limit on how much you can get into this tax-free income stream, with a transition to retirement strategy, there is no transfer balance cap. So there is not a $2 million limit on getting that into a transition to retirement strategy or a transition to retirement bucket. You can transfer $2 million into this TTR account, or you can transfer $3 million into this TTR account. However, you need to be mindful that by the age of 65, that does act as towards a credit towards your transfer balance cap. The other consideration with the TTR strategy is that there are no transfer balance cap implications until your 65th birthday. So comparative to the account-based pension, there is a limit of $2 million that you can transfer from accumulation phase into this account-based pension. Compared that to a TTR, you can transfer $2 million, you can transfer $2.5 million. There is no transfer balance cap implications until your 65th birthday. Now, the last type of income stream that can be paid via superannuation is what's known as defined benefit. Now, defined benefits, how do they differ? They are a type of retirement income stream or a type of retirement product that is defined or set based on a formula, generally years of service and or final average salary. Compared to a standard accumulation fund or an account-based pension or market-linked superannuation product, a defined benefit does not depend on contributions going into the fund or an investment performance. And generally, we don't see a lot of these defined benefits anymore, given they are closed to new members. Some of the considerations with the defined benefit is that it does provide a guaranteed income for life, which is generally indexed or can be indexed to the cost of living. Now, while that might sound good in practice, there are some considerations, especially leading into retirement, is that if you take or opt in to take the full index pension for life, generally you don't have the flexibility like a standard account-based pension where you can take ad hoc withdrawals. So that guaranteed income for life, it will continue to be paid forever or for life, but you cannot draw down on any capital at all. And why that might be important is if you're going into retirement and you have a mortgage or you still have a debt on your primary place of residence, or you don't have the sources to actually extinguish that, and superannuation is going to be your only port of call, then you can't actually take a lump sum from your defined benefit to pay that out. Also, if there's any other big medical expenses, if there's any renovations that you wish to fund, that's also a consideration as well. Now, another comparison to a standard account-based pension or a market-linked superannuation product is that there is no residual balance after death. So what that means is generally your children or your grandchildren or anything, or your beneficiaries generally will not receive a lump sum payment upon your passing. There may be some percentage of the payments that can automatically revert to a spouse, but certain conditions do need to be met. Also, in relation to Centrelink, if you are eligible for any Centrelink based on the income and the asset test, in that with a defined benefit, Centrelink do not assess any account balance. They assess the gross annual income with a deductible amount, generally at 10%.